Hey, good morning and Happy New Year, everybody. Today is January 3rd, 2013, and it's about 5:30 a.m. here, so 2 hours or so before the markets open Mountain Time. What we're going to do today is we're going to take a quick look at the pTheta system, which is a short options trend following system. This is the post out on the blog that I'm looking at right here. So if you want to refer back to something written, this is a good place to go. So it's just called Longer Term Short Options Trend Following Russell 2000 Test Results. And what I did here is I went through a description of the system, and then we looked at 2 years of the results using the Russell 2000. So if you want to read more about it, this is where to go. I'm going to just go ahead and close this for the time being. So what we're looking at now is a weekly chart of the Russell 2000. And that is significant and worth pointing out is that I'm using a weekly chart. And the reason is basically that this is supposed to be a slower moving system. It's longer term. It runs across multiple expiration cycles. We're selling options that have 90 days to expiration. So it's slow moving, and it's not supposed to be exciting, and that's a good thing in my mind. So what we see on the chart, this red line here is a simple moving average, and it's the 10-week simple moving average. And the gray line is the 40-week simple moving average. And those correspond roughly to the 50 and 200-day moving averages. I'm not really using them specifically as part of the system, but they're widely followed, and I think that they're good to be aware of. But we're not going to use them explicitly. The dotted red line is the Parabolic SAR, the Parabolic Stop and Reverse. And this is the primary indicator for this system. So essentially it's a one indicator system, and it's really simple. And that's, the point, really. So if we go to Studies, Edit Studies, and Thinkorswim, you can see here that I have the Parabolic SAR on there. It's just a standard Thinkorswim study. But I've slowed the default settings down to 0.015 and 0.15. So one of these, the 0.015, is the acceleration factor, and the 0.15 is the acceleration limit. So the way that the Parabolic SAR works is the indicator is plotted as some acceleration offset from price, and it moves forward at a faster and faster rate. That's the acceleration factor, up to some limit, which is the acceleration limit. And so what I've done is, by setting the indicator back to the 0.015 and the 0.15, I've essentially slowed it down. And so the result of that is that the indicator has longer periods of trend. And the point is that it allows us to stay in these trades longer. I mean, we're selling options that are quite a ways out of the money. Right now I have a short option down here at 94. And the point is just that we give the market room to breathe. And we know that generally we sort of expect the trend to be higher when it's above the Parabolic SAR. And when it's below, we generally expect it to be lower. Clearly that doesn't always happen. As we see here, we had a fake out and got stepped out of this position, but that's the general idea. And I'd also like to point out that periods like this in the market, where you have essentially a flat market and periods of chop, this system works really well. So you get a stop out down here and a signal to enter short when price is about 78.25 or so. And we're in this for 1, 2, 3, 4, 5, 6, 7, 8 or 9 weeks, say. And we went from 78 up to 80. So really price didn't move against a position that we would have had here. We would have been selling a call somewhere up here above the market. And the system does great. Where the system does not do well is in situations like this, like we were just talking about. We got a stop out and a signal to go short here, and price is at 90.5, let's say. And 3 weeks later, we have price up here basically at 95. And so that's greater than a 5% move against the position in 3 weeks. And in situations like this, this is when the system does lose money. Overall, going back 2 years, I went through 2012, 2013. Essentially, we saw about a 75% win rate. So the system has a high win rate, which is sort of what you'd like to see for an options trend following system, especially one that is short options. What I'd like to do here, though, is let's go ahead and talk about a sample trade, just because it might help to understand the system a little bit better. Right now what we see is price up here yesterday closed at 114.11, And we had a nice pullback here on the first day of 2014, but our indicator is down here at 110. And so there's a really great risk-reward trade set up right now. And let's go take a look at that. What I've done is we're always trying to sell options that are about 90 days to expiration using this. And oh, I don't want to go to March. I actually want to go to, so what I'm going to do is I'm going to look here on the options chain, and I'm looking for the March 14 quarterlies, because those have about 87 days to expiration. So they would have had 90 back on Wednesday. As you probably know, Wednesday was New Year's though. But we're looking to sell roughly a 10 delta option, the naked option. And what I've done is I've already put it down here, the March 5th, 1498 put, because we're in an uptrend right now. So we're looking at basically the 10 delta option corresponds to the 98. So if we take a look at this, we said our stop level was down around 110. Oh, we're looking at my actual position. Let's take a look at this position. So this is our short 98 put. You can see it right there. And 110 is our stop level. So this option, if we could sell it right now today for 64 cents or so, at 110, we're looking for a loss of about $60 if price was to trade to 110 today. Price probably won't trade to 110 today. It's possible though. But if we were to have that happen, we'd be looking at a loss of about $60. And so what we know is that this is effectively a 1-to-1 risk-reward ratio. And the good thing is, because the system has a greater than 50% probability of success, that creates an positive expectancy for this trade. Sorry, I'm having trouble talking. I guess it's a little bit early. So let's take a look at the trade that I have open as well. And this is the standard March expiration cycle, and I have the 94 put open. And so right now this trade has an open profit of about $33 or so, something like that. And if we go all the way down to our stop level at 110 today, I'm basically looking to scratch on the trade. Hopefully, there's probably going to be some sort of a rise in implied volatility if that happens. And there might be a small loss, but it's not a big deal. So that's essentially how the system works. When price is above the parabolic stop and reverse, we're looking to sell a 10 delta option with approximately 90 days to expiration. And so in most cases, those are going to be way below the market. And what we know is that we just sort of expect price to either chop or drift higher. Here, price made a really nice rally. But there are other situations like this where we would have been selling calls up above the market, and price really didn't move in our favor, but we still would have been okay because the short option would have had plenty of time to decay over that. The only time we do run into trouble is in situations like this where we have a sharp reversal against our position. And that's pretty typical for any short option strategy. Whenever price moves quickly against your position, that's when you take some pain. So at any rate, I hope that helps. Thanks for reading, and watch out for the weekend market recap coming out tomorrow. Thanks.